last time we guys did the equity investments part 1. Now we want to part 2 today, right? So now that everyone can see the screen carefully, clearly, and the slides. Let's start. So today we'll cover the topic of security market index and market efficiency. Okay, that's the plan for today. So security market index per se, basically as a part of the learning outcome, we plan to cover the what is security market index. Okay, we look at how to calculate the value. Okay, total return on index. We look at choices, issues, right? How to construct an index, what are different methods, right? We look at valuation of those. We'll learn the concepts of rebalancing and reconstitution broadly, means a lot in the index context. And obviously, we look at the various types of equity and fixed income indexes. Okay? Now, basically, what do you understand by a security market index, right? Now, obviously, it's a very important concept because an index refers to something where you build it up based on various equity instruments and you make an index of stocks that will basically reflect the portfolio and also the market sentiments. So index can be for various things. It can be for equity, can be for fixed income, can also be for IT sector, for manufacturing sector. So index basically will reflect the performance of that entire segment that index is reflecting. Okay. So let's say yesterday, or if the market index is up, it means the whole market is up. If the bank Nifty index is probably up, it means the banking stocks are broadly up. The day it goes down, that means the banking stocks are on the downside. So the index will reflect the potential representation of all the stocks in that particular sector. Now, in terms of the measurement, okay, it gives you a specific segment that you want to pick up. You can actually evaluate the relative strength of the stocks or shares. Now, when you're doing indexing, you're trying to basically create a benchmarking value, which will help you to compare. So like, when you manage a portfolio, you always want to see how well you did, right? If you made a return of, let's say, 20%, it's not always useful to know that you did 20% return till I actually see what is the index giving you. Let's say the market has gained 30% return, but you made only 20%. That means it's not a great return, right? So the index helps you to benchmark your performance and also give you a better idea of how well you have effectively performed. Clear? So benchmark is a very critical aspect or benefit out of indexing. Clear? Obviously, you need to make sure that you create a right index and an appropriate index which is representing the entire market. That is very critical. Okay, and therefore the index should be representative. I will not have some small tiny share in the index which are effectively not representing the entire sector on its own. Each of the securities that you are choosing within the index, those are called as constituent securities because they constitute a part of the index and they're individual securities. So it's called constituent securities. Okay, now the use of an index, we already closed it and said that it helps you reflect the market sentiments, and the biggest use it helps you to benchmark performances of a person, right? And obviously look at risk and return. So when you see any portfolio returns that you are looking at, they'll always tell you that that's the return that your portfolio has given you vis-a-vis the index. So they'll always index it and give you a return based on that. Okay. Okay. Now if we move on, so we've done the index. So the data has gone. Yeah. Can you hear me? So in a price return index, when we do price return index, it's an index where we are only tracking the changes in the price of the security. So price return index will track the changes in price. Therefore, the index will be valued in this manner, right? And this will be divided by the divisor value. So you're summing all the number of constituents in the index into the respective prices of these constituents, right? So the number into the constituent prices, and that will be divided by the value of the divisor. So this formula will essentially help you get the value of that specific index where price is the driving factor. Okay. Now total return index, notice, will track the price, but it will also track the changes in price along with the change in dividend interest also. Because I hope you realize if a dividend is received, right, then the price would also be adjusted, right? If my price is 100 and dividend of 5 rupees declared, the price becomes 95, right? So price is reflecting the dividend amount also. Therefore, when we track the total price return index, I am looking at the other interim cash flows also, like dividend in terms of equity shares or interest income in the terms of fixed income. Okay. Now, price return index, you can do it for a single period or a multiple period. If you're doing a price return index for a single period, you will potentially take it as opening price minus closing price, right? That's a price return index, but you have to then divide by obviously the opening price. Clear? This is the difference. If you take total return index, you're essentially going to look at not just the price return, you're also going to look at price return plus other income. Other income could also include dividend income, interest income. Clear? Any doubts so far? Now, if you're looking at a multiple period return, right? So let's not just say one period, but multi-period return, right? What's the best way to find a multi-period return? You're looking at getting the returns of the index over a greater period of time. So the value of the index, you'll see at the starting time, okay? Then you'll see the value index over the time period, but you'll break up into several periods, period 1, period 2, period 3, and period 4. And you'll try to take a geometric return of those index values. Clear? So that's potentially how you'll get the multi-period, just like a CAGR formula, right? Now, this is how you find the index return. Okay. Now, if I want to find out how do I construct the index? What are the choices I have, right? Basically, you're looking at certain factors of what represents the index, what security. So the higher weighted stock will get a higher weight in the overall index. And it's important for you to make sure that those are surely included a greater weight. A smaller stock, let's say a very tiny stock like PSB, Punjab Sind Bank or something, will not probably find a place or will find a very small weightage in the index. So you should select and weight the stocks accordingly. Clear? Now, there are different weighting methods for index construction. You can do it based on price weight, equal weight, unweighted. You can do based on market capitalization. You can also adjust it based on the float. I'll come to that basically. But I can add or remove stocks and give it a certain weight by looking at various factors. The most common one is price weighted and market cap weighted. Price weighted means what are the price? Let's say MRF is 1,60,000. You have very high weight because the individual price of share is 1,60,000. But the market cap is not so high, right? But market cap of a Reliance or a HDFC Bank is much higher. So uska market cap zyada hoga, so you'll get a higher weight on the index. So I could choose what's the type of weight I want to use based on the index that I'm creating. Clear? So let's quickly go at the different types of weighting the index. If I weight it based on price weight index, that means what I'm doing is I'm weighting all the securities strictly based on the price, which means I will consider the weight, the pricing of each security to decide the weight of that of the secondary index. In this case, what will be the value of the price weighted index? Now remember, price is a factor. So I can take, let's say I have 10 securities. I will take the price of all the 10 securities, right? All the 10. So let's say one share is 25, one share is 30, one is 500, one is 250. And the total of all these 10 shares, let's say, comes to around 4,800. 10 shares. I will divide this by 10. I will get 480, right? Now, if the price goes up tomorrow, I will simply take the revised price, divide again by 10, and find the new value of the index. Old value, new value, the difference gives you the return. Got it? Let's have security 1, 2, and 3. And the price, let's say the price is 20, 80, and 230. This example. So one is very high, other low. Now total comes to 330. So that means the price index is divided 3, it comes to 110. 110 is the price index. Now if the price goes up tomorrow, let's say price becomes 30, right? Let's say all go up by exact 10, 10, 10, 90 to 40. So this will become 360, 120. So you said that earlier 110, now it became 120. 110 became 120 was the difference divided by the earlier number. That is the return you're giving me on the share. Clear? Get the old price index, Get the new price index, find the change in values, and divide by the old index. That's your answer. Take a minute, guys, to understand this. Now, obviously, the biggest limitation in this is you're simply giving importance to price, and the security that have a very high or heavy price will always influence that index, and therefore it will create a bias, and the bias might be in the form of a price bias. So you have to be very careful that when you do this method, you're not allowing a single heavy security to bully its way through and dictate the index. Example, mrf is 1.6 lakhs. Now imagine the position it will have in terms of the price index, right? But mrf being a heavy share, the increase also might be heavier. Clear? Okay, so that's the price index. Now, obviously, those are part of the limitations aspects. Maybe say you can create price bias and so on. Okay, look at the example. Now, you guys try to work an example. Tell me, what do you think is the answer for this? Quickly solve the example. Solve it, guy. I wanted to try attempting some. Prices are given to you. Now, you notice that A, B, C are the original prices. Obviously, a number of units already given to you. Now, as the price of A and B goes down, but the price of A went down and B goes up, and C obviously goes up by a larger number, you will notice that your job is to first make out the index value based on the price of ABC, right? You'll construct the index value by finding the closing value, right? You'll see the answer comes to 90. So difference between the two is your increase in the index value. Clear? Now you'll notice because of these two numbers, 35 and 140, the overall average has increased a lot more, right? Because of one player which has gone signaling up, the others have all gone up. So therefore, that's responsible. The total answer will now come to an increase of 74%. Clear? 74%. Clear with that? Okay. Now, what you noticed here, you did not take care of the number of units. You simply do the price and the price change. Now, do understand sometimes the price is too small. The change might be much greater, but that's on the right indicator. You surely look at the cap or the number of units also. That is more critical. Therefore, the price index suffers from one thing. It does not take care of the number of units, right? But are we clear this example? This is the price index. Find the opening value, closing value, and get the difference, right? Now, normally in this price index, you'll notice that there is a possibility that the original price may have fallen because of dividend, right? Or a stock split. 50 ka share must have become 5 rupees because stock has probably consolidated or it's split. So it must have become, something different. It would have probably become smaller if it's split or bigger if it's consolidated. In that case, you have to make sure you factor the split also. You can't just say, okay, stock price fell down. Example, if you look at example here, let's say I have 10, 20 and 30. So the price index is 20 is the average of the three. Now, if the stock that is 20 has split into 2:1, then it has come 10. 10 is no decrease in value, right? 10 is not the decrease in value, 10 is value because of the split, where one share became two shares, right? Now, if you consider, oh, it's come 10 and you'll find out that 20 has now become 16, which is wrong because it became 16 not because of the value fall, but because split. So what you'll do, you'll try to change the denominator. You used 3, right, in the denominator earlier. You will say, let me do one thing. The 3 that I used earlier, I will now change it, right? I'll change it so I get the answer as 16 point, as the answer is 20 and not 16.67. I want to make sure that 20 continues to come even though stock has split. So earlier you had 10, 20, 30. Now I have 10, 10 and 30, right? But this should not have impacted my earlier price of 20. So now I'll say this divided by what will still give me 20. Understood? So this number becoming 10 should not be impacted. So we are saying let's impact this number also. पहले कुछ और था, अभी कुछ और हो जाएगा. So I'll divide by that number and that number should give me 20, which is the earlier answer. And you'll realize the number is 2.5, which means that effectively what happened? You're going to now change the denominator. Want to open that? Right? So in a split, the denominator will change to the extent of the value that the same answer will come to you. Are we clear, guys? So this is called adjustment for divisor, and this is done only when there is a stock split or a bonus shares or a stock consolidation. Okay. Anytime the stock movement happens without cash, this adjustment will require to be done. Any questions? Okay, now let's move on. The second type of index is called as equal index or unweighted, where you're saying, boss, let's do one thing, give same weight to everyone. Don't look at price or other factors, just make sure everyone has an equal weighting or rating on the portfolio. Obviously, it's far too simple. So simplicity is the biggest advantage, but just way too simple, and therefore it's not helpful. And if you do your, what happened? You need to keep rebalancing the index frequently, which is honestly a pain, right? And you have to give some weightage. So therefore, not the best way to do it, but sure. But it's a useful, it's a easy parameter. How do you find the return of this index? Simple, because it's all unweighted. All you have to do is find the returns of all the securities and divide by n. That's it. So just add the returns, sum of the returns, divide by total number of securities where all of them have an equal weighting. Clear? For the closing value of such an index, it's nothing but what is, so obviously it has a certain index return. The return is probably 20%. So therefore closing value would be opening value plus the, okay. Now let's go on to the next part of index, which is, okay, actually, no, let's quickly find out, okay, the solution for an equal weight index, right? See how it looks like. Equal weighted, all have the same weightage, so don't bother. Right? If it's price index, I'll find a price value and then opening closing. Here, I'll simply say, what is the difference for each of this? Give me the return percentage for A, B, and C. Answer. I want the unweighted return. Can't get answer question. What's the answer here? Okay, what's the value for this A? A has gone up by how much percentage? 25, 5 upon 20, how that comes to 25%, right? B has gone down by around 50%. C has gone up by 33%, right? 60 minus 80. Clear? Everyone's got that bit? So therefore, if A has gone by 25, down 57, and overall up by 33, you take the average of the returns, average values. So 30, 25, 33 comes to around 58. And this is 57%. Right? If you add all of them and divide by 3, you will get an average rating of 0.3967%, which is obviously a culmination of the plus and the minus, the positive and the negative. Clear? Clear, guys? Okay. Now that we discussed how to find the price index and the unweighted index, the next one, the most important tricky part is how to find the value of an index that is market capitalization weighted. Now, as you understand, when I do price, I don't look at market cap, I look at number of units. But when I'm doing market cap, I have to look at, and rightly so in a way, I have to look at what is the market cap of the shares. That's very critical. Clear? Now, so the market cap is a formula, price into number of return shares. Price into number of shares. So if the price per share is 100, there are 10,000 shares, it will be 10,000 to 100, that's around 1 crore, right? So price into number of units, and the weight of that security will be the total market cap of one security divided by the market cap of all the securities. Clear? So it's very clear percentage weight. Fine. And obviously, you know how to find the return. The return is based on closing value, opening value upon the opening value, right? The change. So if I want to know what is the return, I'll first find out the value, the weight, and then see the respective returns. So see, the value of the market value index is the weight of securities is the value that is by the index value. Okay. Now,
So
let's do a
I'm
quick.
not sure if it's me or, but there is some internet issue in between your voice is breaking up. So if you'll try to
Oh, okay.
keep your camera off, so I think the internet connectivity would be better if you can try that. I don't know if it's my
Uh,
internet or it is.
no, is it intermittent? Is it? Because I'm not. Okay. Okay. Wait 1 minute. Huh? Okay. So just highlight to me when it stops or something. I'll probably identify it. But yeah, thanks for letting me know, Nitin. Yeah. Okay. So let me try this for some time. So I'm not sure if it's something I missed, but effectively the market cap weighted index is the based on the market capitalization, which is the price into the number of units, right? And the weight is obviously price units upon the total market value. Water, the bottle. Just I need tell her. Okay. Now let's try sum on that first, and then we'll come back to the main formula. If you look at an example, you need to tell me what is the market capitalization weighted index price return based on market capitalization. So I have the opening price, closing price, and other respective number of shares. So you know the market cap of A company is 20,000, B is 1 lakh 5 probably, right? Multiply, and C is 3 lakhs. Now, if the market cap of these shares opening value is so much, the closing value will be then you'll have to multiply by these respective numbers to arrive at the closing market cap value. Okay, the bottom. Use that. Now try finding out the market cap of the first lot. Okay, total market cap. So 20,000, 1 lakh 5, and 3 lakhs. How much that comes through? 3, 4 lakh 5, 4 lakh 25,000, right? Let me just quickly see. So 4 lakh 25,000, correct? So this is 4 lakh 25,000, which is a base year market cap of that shares, correct? So this amount gives you 4 lakh 25. Now you also know that if you do this amount, 25,000, 45, that's 70, and 18 to 5,000 is 4 lakhs, so that's 470. So the market value cap index value was 425. It has now become 470. So difference is around.
So 10.59 would be the return.
Clear? This effectively is the change in the market cap weighted value. You'll get the answer as 10.59. Any questions? So overall index value is gone up by 10% because of total.
So your voice is not coming.
Yeah, I think I just briefly lost you for 5 seconds. You're right, Nathan. The internet just went off. But I'm just pausing there. So any question on this one? So your answer comes to around 10% broadly. Mota moti 10%. Clear? Okay, good. Well done. 10.59. Okay, so you've learned three things: price weighted price index, unweighted, and market cap index. Apart from that, you can also weight your index using other factors. Water, which is the float adjusted full bottle. Float adjusted market value index.
All of that is full.
Okay, where you take a market value index and you're trying to remove those shares which are not available for public. So basically, when you talk of shares, there's a free float. Free float means जो trading हो रहा है. बाकी there may be 10 or 20% shares held by the promoter or held in collateral or given on loan basis to a bank. These shares are basically restricted shares. They cannot be floated in the market, and therefore we call them as free float and non-free float. So normally promoting shares and other shares, promoter shares may be non-free float shares. Okay, so the float adjusted market index is nothing but the market cap adjusted for the float which is not available for the market. Clear? And therefore you'll see it is excluding promoters, government, large investors, and so on. It gives a better picture of the market, obviously. Okay, now the formula. Get the market value float adjusted by taking a share price and getting multiplied by all the free float shares only. I want to exclude the non-free float shares. Fundamental weighted index. Now here, may say fundamental weighted index, so basically indexing it, weighting it based on some of the fundamentals that are relevant, like sales, net income, net profits, cash flows, and so on. You're using fundamentals, right? In this case, what's the weight you'll put? What are fundamentals using? Put that and divide by the price. That is the percentage. Now, normally these may not be too popular, but please ensure you understand it based on those formulas. You have to find the relevant fundamental factor, and based on that, give a weight, and then again find the weight multiplied by return of security, and you come to a fund value. Clear? Okay, now obviously once you find the fund value, you know the answer is opening fund value minus closing fund value divided by fund value, or you can find the closing fund value by simply saying open fund value into 1 plus fund return, right? Now, right, that may not be guaranteed, but at least it is a return that is expected or estimated. Now, if you look at weighting schemes overview, right now, basically, what is some of the advantage or disadvantage? When you do price weighted, you're simply doing one price, take the prices as the only factor. Obviously, you have to adjust this method for stock splits, correct? Highly simple, but it's real difficult to apply when the weightage, when the when the market cap is different and they need to consider into consideration. Again, equal weighted is completely similar. In equal weighted, they are assuming that shares are split equally. Okay. In price weighted, they're assuming that one person has one share. In equal weighted, it's assumed that everyone has equal number of shares, which is not the case, right? Normally, so that's why the answer is different. In a market weight, it's assumed that all are holding shares in accordance with market weight, market cap. Now, this is the best example because normally market cap means you look at the total price, right? Number of shares, and you take a total market cap of the shares. That is called market cap. So it should be in line with the market cap and the weightage. Fundamental we take the weightage of the fundamentals and we use that as my weight factor, right? So that's fairly a contrary theory. We look at what is the weights, what's the net income sales, and we apply based on that. So you're effectively seeing how the weighting scheme is different for every type, is applied differently, and also they have their own set of advantages and disadvantages, things to look out for types. Here. So this overview helps you to understand what exactly are the various weighting schemes, right? Now, if you look at the example quickly, this is a very critical summary. You'll see share outstanding. There's a free float percentage. There's a BOP point out here. Beginning price or ending price. Dividend is there. You have to tell me, let's see the first question. If the closing price weight index, assuming a device of 4, right? How would a 2-for-1 stock split in share D impact the calculation? Start. So let's do one by one. Answer this. If you have 2-for-1 stock split, how will it affect? Just try solving. Give me 1 minute. 2-for-1 stock split. Yeah. So you're basically looking at share outstanding is 4,000. So this is share D, right? Yeah, 4,000. So every share has become 2 shares. So instead of 4,000 shares, I now have 8,000 shares, correct? How will that impact my overall calculation? Solve that first. What's the impact to divisor? Okay, what's broadly the answer here? So earlier you had 4,000, 10,000, 2,000, 1,000. Sure, number of shares. This has become 8,000, right? And the rest are broadly the same. So we had earlier 10, 15, 17,000, and now we have 10, 18, 20, 21,000 shares. Correct? 4,000 more has increased. They give you a float, they gave you opening price, closing price, and the dividend income. So, what would be the effect of a stock split? Answer if you guys can. I'm looking at the chats. Think of it carefully. What will be the effect of a stock split?
So stock split from 2 for 1, right?
Yeah.
So if 4,000 would become 2,000?
I lost you there again. When you say 2-for-1, right, that was a question. What are 2-for-1 stock split? It means for one. And if you still don't get that connotation, remember split means I'm basically breaking up one share into 2 shares, 5 shares, 10 shares. So one will increase to more. That is called a split. I tear it into more pieces. A stock consolidation is when I combine shares and make 10 share into 1 share or 5 share into 1 shares. Are we clear? So split is breaking up, consolidation is combining. Clear the logic?
Yeah.
Now let's come back to a number of shares. So you had 15,000 shares, you have the price. Okay, look at the price of these shares. They ask you look at the closing price. So you tell me if the stock split here, how much would this price become? 1:2. So that means what was your earlier index value? What was the earlier index value? Obviously, it is the sum of these numbers divided by 4. Right? How much it is? Look at that quickly. 55, 77, 87, 92, and 98. So the answer is 98 divided by 4. which are around 25 and 24.5. So 24.5, that's the earlier answer. Earlier answer for the closing price. Now the question is, if there's a stock split, that means 27.5, 50 something should have given you 24. You're trying to say that if I add the revised numbers and divide by something as x, it will give me the same answer of 24.5. What is something? Find that out, guys. Some of the answers yet? Other on the group? Okay, if I scroll down, see this how the answer comes to. Earlier you got 24.5 based on the original price. When there's a stock split, it became 20. Clear? Find the value of x at which it is 24.5. That's the answer. And you'll see that instead of using 4 in the denominator, they're now saying to use 2.8776. Is this part of question clear? Okay, that's the impact. Now let's come to second part. Are we clear? 2.8776, which is obviously lesser than 4, which was the original consideration. Clear? Now let's find out, like they said, the closing weighted index value return, and assuming a started index of 1000. Okay, they're saying was the closing equal weighted index value, equal weighted, which means I give a equal weighting to all of them. They're saying assuming the index was 1000. Okay, and obviously a return, they want the return as well. So what do you think the answer is? Equal weighted. So I'm going to assume every share has a equal weight, right? So you have to find out what is the total return of every share. Return at a share wise level. So I'll look like this. 50 minus 55, 5 plus my income for period 2. That gives me 7. Correct? 5 plus 2, 7 is my income. Okay. Obviously that's based on 50. So my answer is 7 divided by 50. The return for D. Same for E. 25 minus 22. So it's 3 negative, right? 3 negative. And we'll probably post 4. So my amount will be coming for this E line as overall. Sorry, 3 negative and 0. So it's minus 3. For F, it will be 5 positive. And for G, it will be minus 1. So I showed you only for one. Pick out each one. Okay. I do 7 upon 50. That comes to 14%. Okay. Negative here, 12%. Right? 60%, 24. So you found out that the total returns in every portfolio is so much. All you have to now do is find the average returns. Average return comes to 21.5%. Clear? Is that clear? So this is how to find the total return. Okay, now obviously how to find closing value, very simple. If the returns are 21% and the opening value is 1000, that means 1000 must have become 20% more, which is 1215. That's it. Understood? 21%, increase it by 21%, you'll get 1215. That is your answer. Okay, now the third one, the last sum, this. Okay, what is the market cap with and without float adjustment, closing index value and return to the starting value of this? So answer, what is the market cap? Now when I say with float or without float, remember, if I say with float, I need to then consider this float and try to exclude them from the market cap. Clear? Example D. If I say D with float, without float adjustment, it will be 4000 into 50. But if I say with float adjustment, it will say 4000 into 50, but I remove the float. Okay. And then based on that, I find the return value. Okay, so let's start. First, let's start it without float adjustment. Straightforward. 4000 shares was the price. And remember, they're saying closing index value, closing. So you will take end of price, end of period price, right? So what's the market cap? It is 4000 into 55. Go on. 4 5s are 23. 4000 to 55. Okay. Now, when you do that, you'll take all the totals of all D, E, F, G. You'll get the market cap without the adjustment, and then you'll get the returns. Okay. See here, 4,000. Okay. The market cap earlier was 475. Now it's come to 476. All you have to do is find the value increase, which is 2.11 or 0.211% is the increase in the value, right? If you were to adjust the market cap, I said without adjusting, if I were to adjust the market cap, then you'll say the percentage free float and the market cap and adjust the market cap for the free float. Example, if free float is only 40, then you have to make sure that the market cap is 40. And that also takes you to the concept of index value and index return. Because once I find out the index value, I can find the return from that for any possibility. I can find any return, any amount. Okay. Now these were the portfolio related constructions where we looked at what is the amounts and what's the value. Okay. Now, obviously, once you decide what portfolio value you want to go, what's the construction price, is it market cap? Once you decide all that, you can then start the process of rebalancing and reconstituting a portfolio. Now, what is rebalancing? Rebalancing essentially means where you adjust the weights of the security. Let's say one security is very highly valued or it's high weightage, 25%. Then you'll say, boss, I better make sure that obviously everything is fine, but also he needs it will be you have to make sure the adjusting of the weights happens because the price goes very high or very low, then there is bound to be a price in terms of the factors. Yes, yeah. Now understand what are different between rebalancing and reconstitution. Rebalancing means where the weights are being adjusted. And reconstitution is where you change the constitute itself. You remove one security, add a security. In rebalancing, you keep the same securities, but you are simply changing the weight from 5% to 10% or 6% or 3% is what happens. Are we clear? So rebalance, change the weights, reconstitute, change the securities. Clear? Okay. So when you do rebalancing, remember price weighted need not be rebalanced because it's based on the price and the weight is entirely dependent on the price. Okay. But the others, let's say market capitalization itself, right? They will rebalance, but you need to ensure that if there any merger, acquisition, where any big thing takes place in the number of shares and valuation, you'll have to consider a rebalancing of the portfolio by changing the weights appropriately and then adding them on. Here. Okay, so that's the main difference between rebalancing and reconstitution. So quickly to summarize what we've discussed so far, okay, so I just pause there while I went to this. I said that we have indices. We have the broad market index, right, which is broadly the entire, it constitutes almost 90% of the entire market. We have the multi-market. Multi-market means your indices are created from different markets of different countries. Okay, it's a multi-market where you want to exposure to various countries and jurisdictions. Then we have the sector index, which is very, very popular, like we have the Bank Nifty, we have the iron ore, steel, and so on. So various sectors will have form an index, and then based on that. Style index. Style index is obviously based on the spending capacity, the style. Maybe people's maybe it's based on the large cap or the mid cap. What is the broad style of the consumer? How is money spent? Okay. So that is the equity indices. Under the fixed income indices, we have index for the fixed income category like debentures, bonds, and so on, where the indices are obviously categorized by the broad fixed income securities, right? But we are classifying them into various buckets. Clear? So here you might have the broad market index might be market sector cycle, credit rating related was a credit rating based on the indexes formed, right? Style indices, economic sector indices, and so on. Now this is fixed income, which is mainly the bond or the debenture market. Now what's the biggest challenge in creating an index for a bond also? Same thing whatever we did till broad, we have to replicate that, right? And that is more critical. So harder the equity index because the size complexity is very constant change take place as the bonds mature. It's possible that in the bond market there's a payment, there's a limited life, the limit life also might be violated. So that's broadly what the bond market would probably look at and take care of. Okay, constant change in bond because the volatility is there in bonds. You have pricing changes, and because bonds are only mark to market, there may be some fair value changes. So you have to look at all the aspects when you think of creating a bond index. Okay, so we did equity index, we did bond index. We also have alternative asset index, that's the index of all the alternative assets that you want to create. Like example, gold, silver, commodities, right? In real estate are an alternative form of alternative assets, right? You have a separate topic on this for almost, I think six to 7 points. Exam based, they'll ask often on this topic as well. You be prepared, right? So already assets are those other assets for like gold, silver, where also you have an index for that. Okay. Now if you look at snapshot of what the various indices across the world are having and what is their basis, you'd be quite surprised. Many of them follow different norms and methods. If you got price weight index, you have the Dow Jones, that's very popular for this. You have the blue chip US. Dow Jones represents the US blue chip. They follow the price index. Surprisingly, they go the price, but obviously they don't have to rebalance it often. Modified price in Nikkei, which looks at the price, but it modifies it for certain factors. Free float, float adjusted is basically free float ka hi leta hai. These are S&Ps, some of the FTSEs topics and so on. Free float adjusted market cap. Okay, so first the float and its free float is MSCI index. Market cap related, you have the market VIX and the Barclays Capital, which is a market. Asset weighted and equal weighted are okay, guys. Now attempt solving these three questions. Let's see how this works. And you've probably understood the concept if you get these answers. So I say the 1 year return price index is closest to what a 1 year return. 1 year return. I want price index. So price is year. For the answer, you simplify and difference the price and get the average of the amounts. Right? 22, 40, 34 divided by 3. 28, 50, 30 divided by 3. Get the returns and get the answer. What's the answer? Anyone? Can't answer that question? What's the answer you got? No idea. I'm not able to see in the chat zone as well, guys. Please be alert. Okay. So you look at the average of the two prices and by 3. Okay. And based on that, wait. In the, we have run it on equal weight index. Equal. See, in price, you find a price index already. In the equal index, you don't find any index. You're just simply taking return of each security. Don't find return value or index value. Take the return of each security. Okay. And those returns, you'll find out what is the average returns of that. That's why equal, because assume that everyone has an equal weight. So take each return and divide by 3. 20 to 28, it's 6 upon 22. 40 to 50 is 10 upon 40, 25%. 34 to 30 is 4 upon 34, closing. Let's do this. So basically, if you see the answer here, 13.5% based on that, similar to point number 3. Okay, the market cap value. Now let's look at this. This is interesting. Look at this carefully. The publisher includes 50 corporate bonds removed from the publisher includes 50 corporate bonds. He removes 3 bonds that are nearing maturity and one whose issue has defaulted. And he adds another 4 actively trading bond. So here, because he's removed one and he's added more, he has changed the constituents of the bond market, right? So that means he has reconstituted and not rebalanced. Reconstituted. There's no word called redefined in this segment. Clear? So reconstituted. Which of all is least accurate regarding fixed income indexes? Read that carefully. What's the answer? What's the answer, guys? The answer is, we discussed it. So revenue return fixed income is difficult for investors. That's broadly correct, right? They're saying least accurate. The greater heterogeneity in fixed income, that's also correct. It's not homogeneous the entire time. Due to a large universe of fixed income, data of fixed income is easy to obtain. Easy, it will never be. Fixed income is more difficult and tricky because data large is quite diverse and they have different time periods. Clear? So yeah, here the answer is a little bit more difficult to obtain. Okay. Any questions, guys, so far? Okay, then we go to market efficiency. Okay, it's almost right. Right, so let's take, before we start the next part of chapter, let's take a quick break, guys, for 15 minutes and then come back to do the next part of chapter is called as market efficiency. Okay, it's 5:25, so let's regroup at 5:40, guys. 5:40, everyone. market efficiency, right? Now, the concept of market efficiency is all about how efficiently the markets are running and functioning, right? Now, basically, the financial markets should run in such a manner that all the information is reflected in the prices, right? So tomorrow, if there's any announcement of Reliance and say they plan to purchase or amalgamate or launch a new product, then the price of Reliance share should reflect that announcement or should clearly show the result of what's going to happen, right? So that efficiency is nothing but how well the price markets are efficient and factoring all the conditions in the market. Now, key learning outcome, you should be able to describe them. What is efficiency according to you? What is the importance of efficiency to invest, obviously? And we understand how there is a weak form, semi-strong, and some strong form of market efficiency, and how these three will help you to deal in the markets accordingly. Clear? Now, what exactly is efficient? When the prices of the shares in the market are reflecting all the information that is publicly available, that's called an efficient market. Clear? There's a disturbance, sound disturbance somewhere. Someone's trying to say something. Right. So when all the share in the market are truly reflecting the price and they are incorporated in the prices, then that's called an efficient market. Okay. Obviously, the market is efficient. That means an investor cannot make super profits or extra profits because the market's already reflecting the information and not allowing you to make additional profits without making efforts. Clear? So obviously, in the efficient market, what is a better strategy? Passive or active? Right. Okay, go on. So the better strategy is passive because in a passive strategy, you're basically mimicking the index, the market, and you're making returns which are basically going to mirror what everyone's making. Now, why it's lower is because it's better because the cost of passive strategy is always cheaper because you don't have any transaction cost, don't have to pay taxes every time because you're not buying and selling, and you're getting a standard return from the market strategy. As the market goes broadly up, you'll be making the money, which is why passive strategy somewhere sometimes is better. Clear? So, we covered this. All the aspects are fully reflected. You cannot have super profits. Obviously, passive buy and hold is the best strategy. Costs are low, profits are higher, profit rate return of high is much greater. The time frame for adjustment is important. That's very critical that you adjust. And in efficient market, prices are going to deviate. Okay. So this is how the efficient markets broadly will be performing and functioning. Now quickly let's get some concepts. What do you understand by the word market value? Right? The market value means broadly the value of the shares in the market. That's called market value. What is intrinsic value? The intrinsic value is nothing but the inherent specific value of the shares. Okay, which is different from market value. All right, where I know what is the value of that share based on my knowledge about the specific shares. Correct? And obviously, in many times, entry value can also be determined as the total assets minus total liabilities is the entry value. That if I divide the number of shares, I'll get the entry value per share. Clear? So intrinsic value is the value of the shares in the market based on the knowledgeable investors' perception. In a highly efficient market, this is critical, the market price will always be equal to intrinsic value. So you'll notice the market price is exactly equal to intrinsic value because there's just no scope for making extra profit or loss. Clear? So that's an indication that the market is efficient when the market price is walking into the intrinsic value. Clear? Now, let's understand how does market efficiency really come? what helps us to achieve market efficiencies, right? Now, obviously, in order to ensure that there is market efficiency, you want there to be as many players as possible. Only then efficiency, because everyone will do their bit in the market to make it more efficient, right? So the first important factor for efficiency is a large number of market participants, because all of them are trying to seek the correct price, right? And then therefore they become efficient. So more the players, more the merrier. That's the main aspect, right? You want to make sure that there's sufficient liquidity, allowing for sufficient amount of trades. Yeah, that's how efficient goes. The second factor which helps in efficiency is information availability. You want everyone to disclose accurately. You want there to be sufficient disclosures. You want, see, it's not possible that information will be reflected if the information is not available in the market. So I want a proper availability of information in order for it to be actually efficient. Clear? And therefore, the second and important factor is how readily the information available and the disclosures uh, in the perfect scheme of things. Third, obviously, there should be limits to trading, right? Now, when I say limit, I don't mean generally. No, I just say that the trading should be limited, and other things like short selling or other things which are going to impact efficiency should not be allowed in the market. That is one big thing which will allow you to make sure that there is more efficiencies in the market. Right? Short selling impacts the market in a significant way. So that's something you want to avoid. Okay. So short selling, others which are manipulating markets should be come into play. Thank you. Thanks. Fourth one is transaction costs. Obviously, if you want more efficiencies, you want to ensure that transaction costs and investment costs are reduced to a bare minimum so that markets are functioning and achieving efficiency. So quickly, I'll read these four aspects. Please understand the context of efficiency and why these are going to impact it. Number of participants, availability, disclosure, obviously, limits, and transaction and acquisition cost. Right? Now, the most important learnings. What are the different forms of market efficiency? What are they? Obviously, we have weak, semi-strong, and strong, right? Now, in the weak form of efficiencies, basically, it is a place where the markets are not entirely efficient, they're not reflecting the prices, blah, blah, blah. Semi-strong means more or less they are reflecting prices, but maybe not reflecting every possible price. And strong is where they're reflecting every possible price. Clear? Let's see the details. Okay. In a weak form, basically, the prices that are reflected are only the past prices, right? The current price information are not reflected. So it is a past historical information that is reflected in the market, right? Very critical. So past historical information. So it's possible to test this by doing a certain test where you look at technical factors. You look at the past trend. You can do a serial independence test. You can see using statistics what is the trend and has the trend been reflected and so on. Right? So in a weak form, the past information is reflected, not the current information that's publicly available. In the semi-strong information, the current information that's publicly available is also reflected. So semi-strong market will clearly show and reflect and adjust all the information, past as well as present. Clear? And obviously, present means those that is available on the domain, which is already disclosed to market and announced. Right? Then if we come to strong, what does strong do then? Strong will disclose past and present, but also not just present that's publicly available, but present information that is also not yet publicly made available. Right? What is the information? Could be information that is probably sitting with insiders, sitting with certain people in the market, certain top players, certain maybe board of directors know about this information. So obviously the information should be reflected in the market news, right? And that's why people tend to speculate. They'll know what's happening. If a meeting takes place between two top companies, they will assume that there's some merger talks happening and they'll start reacting to it, right? So even before the news has reached the market, people start reacting to the news, and that's where it takes place. Clear? So strong form. Now, obviously, I'm talking about public as well as private. Both information should be available. Clear? Now, from the nature of this only can make out that not everyone can sit and make profits in the markets if if it is already reflecting the news. So therefore, you have to be careful to understand what type of markets will help a person to make what type of profits. Clear? If it's a weak form of market, then obviously a person can make profits only if he has publicly available information and use it. If it's semi-strong, then public information will not help him. He should have prior information because in a semi-strong, public information is already reflected. So there's no point. In a strong, he can't make any profit because public, private, both information are available and both are reflected. So having prior information also will not help you in a strong market. So basically, a strong market, the point is you will not make any super profits at all. Clear? Okay. So understand that the market efficiency helps you to understand where what profits can be made. Okay. Now let's quickly look at fundamental and technical. Now, fundamental analysis is basically where you are analyzing the market based on the fundamental factors. Example, you're looking at EPS, price earnings value, price to book value, and so on. So you're doing a fundamental analysis of markets. You're trying to analyze which shares are good or bad, which shares are good to buy based on certain fundamental factors. Clear? Technical analysis on the other side is where you're trying to find out which shares are good or bad to buy based on the technical movement of the share price pattern, the trading volume, all of that. All of that helps you to detect which shares are good to purchase and which shares are not worth holding on. Clear? So, fundamental basically based on the fund analysis, technical based on the price pattern and other behaviors. Okay. If you are, and obviously you'll realize fundamentally you can make money in a weak market, but semi-strong is a little bit tricky because it already connects. Technical analysis, you'll make money no market because you're already affected uh, in the weak market. You're already reflecting the price. So in weak for market, you can't really make more profits. When it comes to portfolio management, right? If the markets are in the weak or semi-strong, then the consequences that active trading will not give you abnormal return because the markets are already weak or semi-strong, right? So that means if you're doing actively trading, you're not likely to maybe get abnormal returns. But if you do passive, right, you will be able to do a better portfolio management and better returns because passive market is already helping reduce your costs and reduce your taxes. Clear? So weak form market is supported by most tests, obviously. Semi-strong leads to mixed results because we have prices which are adjusted rapidly, or it may not happen any occasion. In a semi-strong, in a strong market, now you're trying to say that the strong market is supported by prices which are also privately held by people. You can't prove that, right? That the information that's held privately is being reflected in the price of the market. It's very difficult to prove that. So therefore, there are no tests to prove the efficiency of a strong form market, right? That's a little difficult to prove, and therefore they are not supported by any test per se. So apart from tests, it's important to understand whether these markets do exist, right? And therefore the implication of these markets on your overall analysis is very important. Example, when we say technical analysis, we're doing basically the historical data, but it's useless in a weak form or semi-strong. When you fundamentally, we say, okay, we'll get good results by looking forward, and we can do that in the weak market, but not in the semi-strong. Security analysts and money managers, so CFA charter holders, they have superior analysts, they have amazing research. Even they are not able to outperform the market because even they know that the markets are in a semi-strong or strong mode, and therefore you can't outperform the market even by having better analysis because you're missing out on the private information. So I paused there because we lost the data for some time. Let's get back to the next concept, which is market anomalies. Okay. Now, market anomalies are basically where there is a certain anomaly in the market that is happening on a regular basis based on a certain aspect or time period, right? So basically, I have a definition of anomaly is where something that does not follow the common rule. When I say the markets are efficient, that means markets should follow certain efficiency hypotheses. It is possible that this hypothesis will not be followed despite having a rule to it, and that is called as anomaly. Okay. Now this anomaly takes place when a price increase or decrease happens even though there's no information in the market, or an information came in the market but the price has moved in a different direction. Good news came but still the price has gone down, or maybe there's not such news but the price has gone up. So how come it's an anomaly, right? That's the problem. How come it's an anomaly? Is that's important, right? So when I go to anomaly, I will help you explain what anomalies are, okay? And we have to understand this anomaly. Example, today in the market, right, is more of momentum and overreaction. Sometimes people are going with momentum. Example, Indigo, what happened 2 days back? Everyone knows the news, right? Indigo had some operational issues, flights were cancelled. So in this case, when the prices are happening, it could happen because some other reason that's called an anomaly, like the Indigo example, where the cancellation of share of flights fell, the market fell down because there was a momentum, there's a reaction. People were more of following emotions. So that's called an anomaly, right? Nothing really major happened which will affect the future share price. So the moment you have an anomaly, there's a chance to earn a return that is more than the average expected returns. That's called an anomaly, right? Okay, obviously an anomaly test challenges market efficiencies and suggests the potential to earn above average returns. That's critical. Clear? Now, example, if you look at some anomaly like time series, calendar, you'll notice that sometimes the prices boom up in the New Year's, or it may go down in Christmas because there's a bit of a slag, right? Size effect, value effect is based on the size and value effect. Close end fund discount. Suppose the earning surprise, right? Sometimes the earning surprise also might give you a boost in the price without really having a fundamental impact out there. Okay, IPOs, that's the biggest anomaly. Everyone knows that IPO prices are very high despite it not having too much of a boost in that. Clear? In December, there tends to be quite a bit of buying at the year end, right? And they pick it up. And then in the January month, there's a little bit of slag where starting to sell and people will start making higher returns because probably at the turn of the year, there must have been an increase in the prices, which have given you higher returns. Turn of the month, maybe the returns are higher on the last trading day and the first 3 trading days because that's when the most momentum takes place and the returns are most higher. That is a calendar anomaly, right? Day of the week. Maybe average returns are lower on a Monday, but they're higher on Tuesday or Wednesday, right? That's a day of the week effect. Weekend effect. Returns are higher on a weekend because then people are closing and trying to book the profits. And Monday it will be much lower, right? So they are calendar time series. Then you have momentum. Momentum is based on the reaction of the people and the momentum, how the stocks are moving, what is the moment of the shares. Obviously, many times this may result in overreaction, like what I told you yesterday, 2 days back, when Indigo flights were cancelled. Everyone overreacted and the shares crashed because there was a momentum effect. Now that's clearly an anomaly, right? Because they did not announce that Indigo is suffering a loss or the shares have fallen. All they said is flights were cancelled and the shares fell by 2025. So that's a clear anomaly, right? Momentum effect. Right? Unexpected. Suddenly people got unexpected bad news. Unexpected. No one expected flights to cancel. So that's a momentum effect. Clear? Overreaction. Size effect. Sometimes The size also might matter, right? The shares of small cap company are outperformed. You know that very often shares small cap will always have outperform because the value itself is so small, yeah. So, the size effect is value effect. Now, value effect, little similar to that, are those that are called as value shares because they have a smaller price to earnings. So basically, they're quite undervalued shares. They have a small price earnings or a small price to book value. So the price are generally undervalued. So they are called as value buys, right? It can be bought for a certain value and they're called as value buys. Okay. So size effect is where the shares are of a small size company, and value effect is where you're buying shares based on the value that the fundamentals are giving you. Okay. Category three, other anomalies. Basically, the other anomaly like closed-end investment fund discounts, right? Clearly, they are trading at approximately their NAVs. Whenever there's a fund, you notice that they'll always be equal to NAV. But sometimes you have some funds that are trading at a discount to NAV. How is that possible? That could be possible. There's some illiquidity happening, or there's some illiquid discount, and so on. So these are trading at a much higher discount. Clear? So they're not necessarily at the fund value. Okay? It clearly should not happen. Earnings surprise. Earnings surprise where they've announced the earnings, but there's a surprise announcement. Very often, Reliance and other companies, they use a strategy. They try to announce earnings and they'll give a big surprise. They'll say, today we're announcing this, we are building up this. So people are more than happy and excited, and the share price will reflect that surprise. And that's more critical. Clear? So earnings surprise may, this is how the earnings are going to highlight much higher. Companies that show the largest positive earnings surprise tend to showcase superior returns. So the higher the earnings surprise, you'll always have higher superior returns. So just look out for those aspects. Investors, they obviously could earn. So suppose you want to end, you will try to buy those shares which have a higher earnings surprise and make money. And a share that gives you negative surprises, right, will always have a lot of selling happening in those shares. Clear? IPO is the best example, and you must be seeing around. Everyone knows that IPO shares are always kept at a lower price because they want the IPO to go through. So you'll see most of the IPOs that are coming out today, most of them are always listed at a premium and they're fully sold out. And after the listed, they still continue to rise because the true price is not yet factored, not yet found, identified. Now, a very interesting topic, interesting one, behavioral finance. This is nothing but the behavior of the people when it comes to finance. Okay, this is very easy to understand and observe. You'll notice that when people behave in a certain way in the world of finance, it's only because of this behavior that comes across on them, like herding behavior, right? Where investors are potentially following right. Sorry, I'm back. So herding behavior is where everyone will do what others are doing, right? It's just because other people are going the crowd, the people will follow the crowd, and that's called herding effect. One investor will not follow his gut or research; he'll follow the actions of other investors, which is honestly very scary, but that's often something that often happens. That's why you have things like upper circuit, lower circuit. When everyone's buying, then you'll also enter and start by saying, I also want to buy. You'll buy the crowd. Lower circuit is when everyone's selling, you also will sell, right? So that is called herding behavior. Loss aversion. Now, loss aversion means people are scared of a loss, right? Even though the same amount of profit also is possible. So suppose, let's say I tell you that this investment might give you a profit of 20 rupees or a loss of 20 rupees. You're more scared of the loss of 20 rupees than the profit of 20 rupees, even though maybe both have same probabilities. Maybe the profit has a high probability, but you're scared because loss to loss hai. So your loss aversion is always greater. And that's a behavior aspect. Overconfidence bias, very interesting. Overconfidence is when people are overconfident about their ability to process and interpret the information. Right? They're like, okay, it'll be done. That's overconfidence bias. Information cascade. Okay, is when the information is cascaded down to the other people. So the uninformed trader does not really know what to do, right? So what will he do? He will look at the other informed traders. He'll assume, "Arey yaar, wo to kharida to must be good only," right? He will not bother to check. So information gets cascaded to a level that you're not entirely aware. Okay, and that's critical because you want information to be there, right? Apart from there are a few other biases. Please learn these and know them well because they may ask you tests on which bias it represents, right? Representativeness bias, right? In a representative bias, right? You are trying to assess various information, right? And look at the outcomes, right? You're trying to make sure and check the, how familiar you are and trying to come to an answer based on the new information that's come to line, and you're trying to see a representativity of the scenario, right? Mental accounting, similar things where you're trying to bucket the securities into different mental buckets. You're trying to basically work out it not as a portfolio, but more as individual securities. You're breaking up into different buckets, and that's called mental accounting. Conservatism is when people are not reacting. They're being very, very, very conservative. They're like, no, 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 we're not too sure. So they are not reacting to the new information as immediately as possible. And obviously, the last one is your narrow framing, where the investors focus on issues in isolation. They'll not give a context and they're like, oh, okay, fine. It's not about, they're giving up more on it. So that's called narrow framing. Clear? So in behavioral finance, we have more simply herding behavior, loss aversion, overconfidence. These are all part of behavioral finance. People are able to actually connect with these behavior talents, right? And others will include mental accounting, representativeness, consultants, so on. Clear? So this is broadly what we learned in the things of market. Now, always when you finish reading something, guys, please ensure you always go back to your learning outcomes, which is there on the first page of every chapter in your Schwezer manual. Please read that carefully. And then based on that, you are sure that you have learned everything from the discussion. So example, I'll just quickly check. Did we describe what efficiency is? Yes, we understood the importance of efficiency. Did we distinguish market and interest in value? Yes, we discussed that also. What factors affect efficiency? We saw that. Then we clearly saw the difference, right? Of weak form, semi-strong, and strong form. We saw differences. We saw the implication of each form of efficiency, right? How it affects your fund analysis, technical. We have seen that bit also, right? How does it clearly affect the three, right? And then we looked at what are the anomalies in the market, right? What are the various anomalies, why they exist, how do they come to play, even though the markets are efficient, why is it an anomaly? Correct. So basically, all that is what we already studied, right? And it's important that you are able to connect these dots. So quickly, if you look at some of the quiz questions, see question number one. What's the first answer? Investors who exhibit loss aversion, most likely, if they don't like losses, are they what? Are they risk averse? They dislike losses more than they like equal gains, or they are symmetric risk performance. They don't like losses, right? Right? Are they risk averse necessarily? So the answer is what? A, B, or C? Potentially loss aversion, right? So they're trying to avoid losses, right? And they're trying to therefore be more averse. You can say they're more averse to risk, but they are not liking losses. They dislike losses more than they like the gains, right? So the answer will be more of C. Okay, be careful. It's a little scary one. You may even say it as having highly risk averse, but the correct answer, they dislike losses more than gains of the equal amount. What is this answer in terms of in terms of market efficiency? Short selling, what does it that lead to? So you do know short selling means selling something that you don't own. So when you do it, what does lead to? Excess volatility? Obviously not, excess, you're not selling something or buying. Does it promote efficiency by making assets less likely to be occur, or is it has little effect on market efficiency? Was the answer. Now, obviously, short selling does not promote market efficiency. You already know that. It has much little effect. See, basically, short selling, if you're looking at it from here, short selling promotes, okay, has little or more effect on market efficiency or promotes market efficiency by making assets less likely to become overvalued. Okay, probably I'm not sure to what extent can in promote it, but short selling normally is a restriction that happens uh, to ensure that the markets are becoming more efficient. Okay. Now the weak form EMH asserts that stock price fully reflect which of the following. Now when I say weak form, right? Weak form means it is reflecting only the past data, right? So what's the answer here? Fully reflects, right? Public information, public and private, or none of this? The answer is market only, because in the weak form, I'm reflecting only a past information that's in the market, not the public information which is in the market, and also not the private information. So public private is out of question. The answer will be market only, right? 3A. Weak form reflects all market past information, not the public information. Clear? Now, a market in which assets market values are equal to or nearly equal to value is best described as a market that is attractive for. When the market values are the same as intrinsic value, what do you think the market is? Obviously, it's an efficient market, it's a good market. And in an efficient market, you would make money only and only if you are trying to do passive investment. Clear? So the answer would be more of passive, because remember, in passive investment, make a note of this, guys. Understand that when you do passive investment, you're basically not paying regular taxes, right? And also in passive investment situation, you're also entering in a scenario where you are actually not paying towards a brokerage cost, transaction cost, and so on. That is passive investment for you. Clear? So the answer will be where it is more for passive investment, where you won't get any superior returns. Clear? Now, expected effect or market efficiency of opening a securities market to trading my foreigners would be. Tell me, suppose the market is opened up to foreigners, then what will happen? There'll be more players or less players. So think of it like this. Opening a market to foreigners will increase, right? Will increase the number of players, will have more people, and therefore there is more of those. There'll be more efficiency in the market, there'll be more trading, and therefore there will be more build up of market efficiencies. Information efficiency will also be increased. So therefore, having more people in the market will build up your market efficiency, and that's really critical. Okay. So this is the answer for opening up. So therefore, remember, and that's what I meant when you say the factors that affect your market efficiency, you should look at the effect of those factors, and that's what you mean by saying when it's for foreigners, it's for secondary market, that's how it will build up on. Clear? So this is on efficiency. We looked at the theory angles to equity markets, looking at efficiencies and markets and how they work, right? Including real finance. All this are theory part. So I think with that, mostly finished earlier because we had theory. So tomorrow we will reconvene, and tomorrow we will look at the most important part of equity, which is the things evolving on valuation. How do you value? So please do not miss this for the world, because this part is almost the heart of every CFA, and it's also the heart of the equity topic, right? Because almost 80% question of my equity chapter will come from this topic, and most of the level 2, level 3 also will revolve around valuations. Okay. So tomorrow, and obviously we'll do it on the board more than on the screen, but we'll go through sums. I want you to come prepared with your calculators and obviously your books and notes, and please solve the sums that we do tomorrow, because this will be the most critical part of your learning for, yeah. All your portfolio management, all your decisions are taken based on the valuation. So valuation is very critical, guys. Please pick them up carefully and make sure that you guys work it out carefully. Okay. So I come tomorrow prepared for the valuation topic. Okay. Any questions from your guys before I wrap up today's chapter? Any questions? Great. Okay. So Mahesh, Teeraswini, Aditya. Right. If no more questions, so we'll wrap up the class, and I'm going to see you guys tomorrow. Okay. And I'll probably do it with the classroom classboard part where we can solve the sums together. Okay. Any queries, please let me know. Bye, guys.